What up, Tostie?
How's it going? Good evening.
Good evening, brother. I'm well. How are you?
Doing well also. Thanks for coming in. Is that Dennis?
Yes, sir.
Denise. Good to see
Denise.
you.
Yes, sir.
Denise. My fault.
Denise.
My fault. I'll get it right next time.
You're all good, brother.
How's everybody's day been so far?
Good, brother. Just step by step, day by day.
That's what you got to do. It's you can never let anything that goes right or wrong get your head too inflated for the next day. Just like anything, right?
I agree.
Very cool. We'll get started here in just a couple minutes. We'll give everybody the chance to kind of file on in here. While we wait, any questions, comments, anything that anybody wants to discuss before we get going? If not, no big deal. We could start just kind of flipping through some charts while we wait.
I have a question. So, today, remember we were going uptrend? That is the uptrend,
I lost you there for the last like
right?
15 seconds. You said what?
We had an uptrend, all the way up, and then we had a
Yep.
pullback,
Yep.
and then the wicks didn't fill. So, and then it went back up on SPY.
You talking about like these wicks?
Yeah, those wicks. Like if those filled, you think we would have had more downside?
It's an interesting question. It's a concept that I've heard before where people talk about, seeing these wicks, like long wicks to the downside hold as support can be a bullish sign. I don't disagree with that at all. And I think, from a intraday standpoint, this level did become real important real quick, 595.
Yeah.
To me, though, the bigger level here on the day is right around this previous high that we just set just a couple days ago, and I just drew this level a little bit ago, so it's not quite perfect. But if we just dial this in a little better, this is 595.54. 595.54. To me, this level is really the one to watch, right? Because this was kind of that previous high on the daily.
Yeah.
So yeah, while that wick ended up being important intraday, this level to me is actually even more important. And obviously we had two bars below it, which is going to happen from time to time. But this was really the spot to hold. But I don't disagree with you. I think it's definitely
Yeah.
something to look for, right? Obviously, at least from this
Yeah.
course alone, when we see these long downside wicks on elevated volume, all that means to us is there's buyers there, right? So
Yeah.
long as we hold above this spot,
Yep.
it's not a bearish thing. So I don't disagree with you one bit.
I appreciate that, brother. Thank you for
Yeah,
clarifying that.
absolutely. And I think you're 100% right. I think you're 100% right. Just depends on how you look at it. I mean,
Yeah.
you could even turn this into a zone and say, once we set this wick, this whole area is
Mhm.
what's most important.
Yeah. I caught some puts going down, and then once it went down, I sold right away.
Okay.
Scalping. Yeah, today I
Yeah.
saw some puts on that.
Yep. That's what you should be doing, right? In an uptrend, you got to be real cautious when you're playing against it.
Yeah.
And it sounds like that's exactly what you did. So not a damn thing wrong with that. I mean,
Yep.
we had an absolute ripper of an uptrend literally all day. So,
Beautiful.
um,
It was beautiful.
and it sounds like when you short those trends, you could get paid real nice.
And
Um,
quick.
but it's not a trade to sit in all day
Hell
typically.
no.
And there's always
Hell
going to be the
no.
ones. There's always going to be the ones that you look at and you're like, man, I wish I didn't sell. But I mean, that's just like anything, right?
Yeah.
It's a great question. Yeah, while we keep waiting, Amir, let me send one more message letting everybody know we'll get started soon, and then we'll take a look at those charts that you're interested in. Why not? Why not? All right, so we want to take a look at Tesla real quick. Let's take a look at Tesla. We'll just pick one of them. Let's zoom out. So in general, I think we've talked about Tesla at least a little bit recently. Big ripper once we broke the 200 simple moving average and kind of stalling out a bit here. You can see if I extend these prior kind of key levels to the right here, stalling out in the area where we may expect it to. Pretty big daily levels right around this area. Also, some just overall weird price action off of this prior high today, right around that 350 spot. Um, to me, it's not necessarily my favorite. I think there's better names in general in the market that are set up and have been set up in the short term. And my philosophy that I'll talk about in lectures and always have talked about is always focusing on strength, right? Especially when we're in still a relatively new uptrend, right? don't be afraid of the names that are the strongest, right? The names that have led the market out of the, I'll call it correction or bear market. Hood's a great example, right? This name started moving significantly higher once the S&P bottomed. It actually bottomed before the S&P. And if we just go ahead and compare these two real quick, just something quick, let's do this. So if we do it like this, so the S&P put in a bottom on 4.7 here. Hood bottomed, okay, I guess same day. Anyway, it came and set a higher high a little bit quicker. So Hood set that higher high on 4.14, where it took S&P all the way up to 4.25 to set that higher high. So I'll zoom in so you can see what I'm talking about more clearly. Just like this. So we can see Hood broke these previous highs set around 44 back on the 14th, where the S&P on the 14th was not even close. It was red on the day, and it wasn't back above those pre-tariff highs, or the pause day highs. So long story short, for me, I'm always looking for strength, and this is a great example of a name that was showing that strength early, right? Setting that higher high, higher low, far before the rest of the market. And long story short, we can see how it's performed since that time, right? So early strength is definitely a very positive sign. There's a lot of other sectors that show real significant strength as well. Taking a look at some of your cybersecurity names, CRWD is a big one that just reported earnings today. I know Tilio's been all over this, and what seems like a pretty decent pullback. I haven't read the report, but pulling back right into these highs after hours, and obviously one of the strongest names in the market. So that was a long way of me not answering your question, but long story short, I'm always looking for strength in the market. And Tesla for me just doesn't quite have it. Does that mean, it's not going to go up, in the next couple of weeks? No, it doesn't mean that, right? It's just not the highest probability setup for me at this time. Nothing wrong with that, right? Doesn't mean we can't trade it, but it's just not necessarily my favorite at this time. The one thing that Tesla does have going for it that a lot of other names don't is that it does have kind of that catalyst of Elon reducing his involvement in the government, and then obviously tariffs as a tailwind, right? A lot of Tesla's manufacturing and components are sourced overseas. So as tariffs continue to fade away, that's going to be a positive for this company. Cool. Okay, that was a good start to the class. Let's get into it. So we're on lecture 3 of the volume price analysis series. We've started this over the last 2 weeks. So we did the first lecture, which was just kind of a general background into the market and kind of the foundations of EPA. And then our last lecture was really getting into the most basic concepts. So we talked a lot about kind of high volume, what that means, and kind of a strong bull bar candle, what that represents. And we also talked about kind of the 3 main laws of volume price analysis. And we'll recover those just as kind of a recap to start us off. So I assume the majority of us have been in the last 2 courses, but if anybody's in the chat tonight who hasn't been in the last 2 courses, can you let me know? Just because I'm curious. I'm not necessarily going to change how the entire class flows tonight, but mostly just want to understand, and maybe it'll influence how I talk about things. So anybody here who hasn't been to the prior 1 or 2 course series, just the last 2 weeks of lecture for me? Everybody's been here every time? I know I see some familiar names, but I'm sure there's got to be.
I don't remember, but I think, was I here for the first one? I don't think so.
I honestly don't remember. Honestly,
Yeah.
I wish I had a good enough memory to remember every single one of you guys in here. Scotty, I could have sworn you were in the first. Maybe it was just the last one. Okay, so we got a good group of people who have been and who haven't been in the last couple lectures. So let me actually take a.
Put that convert a wash.
What was that, Michael? Oh, maybe you didn't mean to talk there. Okay, that's fine. So let's actually spend some time just kind of introducing it a little bit. Just again, sorry for those who have heard this before. Couple things to mention before we get started. This is a pretty quick course. It's meant to be watched together. So it's a 6-course series. The prior 2 should have been uploaded to the YouTube by now. So you should be able to get the links to those from Discord. Long story short, the volume price, no, you're fine, Michael. Don't worry about it. Long story short, the volume price analysis course series is really meant to provide a high-level understanding of a really incredible trading system, in my opinion. Obviously, I'm a little bit biased, but volume price analysis really gives traders a framework to think about price action systematically. And we talk through a lot of different examples in this class to help you apply that in your actual trading. So I like to think this lecture is kind of structured like what you might expect from a college course or a high school course, in the sense that it builds kind of on the concepts that we talked about in earlier lectures. So I do my best to recap the concepts that we've already covered at the beginning of lecture, but I'm not perfect. And unfortunately, I can't rehash every single lecture every single time, or else each lecture would just keep getting longer and longer, and you guys would all be done after the first hour anyway. So anyway, prior two lectures are uploaded to YouTube. We've covered so far just kind of the history of the stock market and kind of how this system has evolved. And then last week we talked about some foundational concepts. So I'll spend a little bit of extra time today just kind of reminding everybody about those and just recapping what those foundational concepts of volume price analysis are. As you guys have probably figured out already, over the past few months, I've been keeping mics unmuted for everybody. So feel free to just interject and talk whenever you want. Yep, just interrupt me and start talking over me and I'll start listening. Cool. Okay. And I always like to start these lectures with an acknowledgement of this book here. This is a complete guide to volume price analysis by Anna Cooling. A lot of the course material that we talk about today is actually derived from this book. It's an incredible book. It's pretty cheap. It's like $15 on Amazon. It's a quick read too. You can get through it in a single day if you wanted to. Yeah, definitely recommend if you guys have even a little bit of interest in the concepts that we talked about tonight, or just want to expand your knowledge overall of technical analysis in the stock market. I couldn't recommend taking a look at this book anymore. This is where I learned a lot of this stuff from. I can't act like any of these ideas are my own, because they're not. Everything that we talk about in this lecture is basically either something that I learned from here or something that I pulled from other knowledge, but wanted to call this out. Okay, and just a quick overview into the course. So again, we're on lecture 3. We've already gotten through lecture 1 and 2, which I kind of described already. And today we're going to get into some more complex applications of volume price analysis. And again, as I mentioned earlier, the goal is really to get everybody a clear understanding of what volume price analysis is, how to use it, how to recognize these sorts of patterns. And ultimately, the goal is to get you guys all to apply these concepts in your own technical analysis to either supplement or create a brand new trading system for you. And I was listening to something earlier this week, some lecture or video on YouTube, I think it was last night. And I don't want to just repeat this quote because I think it's pretty cool. Oh, $39.99 for paperback? Wow, that got way more expensive. I swear I just looked at it and it was like $15. I don't know when that, I don't think I paid $40. I mean, if you have a Kindle, yeah, $2 is pretty cool. Definitely can roll with that. But one thing that I heard recently that I wanted to just share with you all, because I thought it was pretty valuable, is becoming an expert doesn't just take hours and hours of study, right? It takes practice, right? It takes obviously the hours of study, but it takes hours of practice, and it takes continuous learning, right? So you can't just say, you came to these 6 lectures and say you're done forever and act like you don't need to study or implement these concepts at all. So anyway, what I'm trying to say here is these lectures are hopefully meant to get you guys a really good understanding, but a lot of the work is still on you to go and implement these concepts in your own trading, right? You can't just think that you absorbed all the knowledge from here and just be 100% an expert and ready to go. There is a lot of practice that is required. And that goes with anything in trading, right? Or anything in life too. You could watch a lecture on whatever, and that doesn't mean you're going to be an expert if you don't do the homework and the tests and practice and continue working on that skill with increasingly difficult problems as well. So anyway, wanted to call that out. Okay, so let's start off with a quick summary of what we covered in last class. Damn, that really is $40. Wow. I did not know that. Paperback. Well, that's the full color version. I'll say mine wasn't full color, and it did kind of suck. It was kind of annoying when it wasn't full color, to be honest with you. So I'll let you do with that what you will. Okay, so a couple things that we covered in last class. We covered a lot of really important stuff. So yeah, $25.99, that sounds a little bit more realistic. Was that? Okay, yeah, that's in dollars. I had to make sure that Scotty wasn't like somewhere else. Anyway, yeah, $25.99 sounds a bit more realistic. Maybe I was wrong and it was never 15 and I'm just lying. Okay, let's talk a little bit about some of the most kind of important rules of volume price analysis. So the first one was this concept of effort versus result. And just so you guys know, just to recap this example, the bottom left image here represents volume and the bottom right image here represents price. And basically each one of these volume bars corresponds to these candles. You'll have to just trust me when I tell you that they're from the same chart. And what we discussed is that in general, we should see when volume is the effort and price is the result, if we see below average volume, we should see a small spread. And that term spread might be a little bit confusing to you guys if you haven't heard it before. Really, the spread is just the difference between the open and close price. So for example, this doji candle here, and I'll even, here, let me do something else to make it really clear, because I know sometimes for people on mobile, it's pretty hard to like see what I'm talking about. So let's just, I don't have any good software to like draw on the screen, so I'm just going to do this. So this, for example, is a good example. Oh, of course it's red. Let's make it, hopefully everybody can see this orange. Let's make that a little bigger. Okay, sure. So this is an example of a small spread candlestick, right? The distance between the open and close is very small. This, on the other hand, is an example of a large spread candlestick, right? The difference between the open and close is significant relative to the rest of the candles in this period, right? Overall, this bar here definitely has a much larger spread than the rest of them, right? This one has a decently sized spread, this one here, maybe these two, but overall, this bar here in the top left clearly has the largest spread. So back to our example here. In general, we should see these two kind of effort and result. I don't even know what I was trying to say there. We should see effort and result correlated to each other, right? So when we see high effort or above average volume, we should expect an above average or larger candle spread, which you can see in this first example, right? And when we see a smaller spread, we should expect below average volume, which we can generally see, right? These bars to the right here generally have below average volume and have smaller spreads as well. And this is generally a concept when volume validates price, right? And this is something that we really want to see on a breakout or a hold of support, right? On a breakout, we want to see above average volume and an above average spread, right? That would be volume validating price. However, oops, the animations are backwards. This isn't always the case, right? Just like anything, the market doesn't behave scientifically, and it's not always going to work the way we want it to. And as a result, sometimes we see below average volume, but we see a massive spread, or we see above average volume and a small spread, right? And this is going to be referred to as a volume price anomaly, which is a concept that we talked about in the last class. And we'll continue to kind of expand on what this means. In general, though, volume price anomalies aren't necessarily a signal or anything else for us to make a decision off of. It's really just represents a lower confidence environment, right? So it doesn't necessarily mean to either go short or long, but it means we should probably take a step back and evaluate a little bit further and see if this is an environment that we really want to be involved in. So anyway, that's a recap of effort versus result. I really wanted to recap the 3 rules really quick. Let me pull that up. Give me 1 sec. I think that's kind of important. Give me 1 sec. So I think since those who didn't make it last time, we should definitely cover that. Okay. All right, let's go through our 3 main rules of volume price analysis here, or our laws of volume price analysis. Okay, whatever, I don't know. So we have kind of 3 main laws of volume price analysis. The first one being supply and demand. And the analogy that I think I gave for this one is a PS4 or PS5 or whichever one is the new one. When that PS5 first came out, there was obviously a fixed supply, right? There's only so many that have been made and so many that they're making every day. And obviously demand is really high, right? Everybody wanted the PS5. Everybody wanted to buy it. It's the new thing. You know, everybody wants to be there on release date. And for those of you who remember or maybe tried to buy one, the price of PS5s at the time were like twice MSRP. So if they were listed for $500 by the manufacturer, by Sony, PlayStation, or whoever makes it, they were reselling on eBay and everything else for $1,000 or more. So this would be a case where demand significantly outpaced supply. And as the PS5 was released, what was that?
You got your answer, but hell.
Yeah.
I think Blake doesn't mean to have his mic unmuted. That's okay. Anyway, long story short, right, as the PS5 continued to stay released, right, demand slowly subsided and supply stayed the same, and the price returned to normal levels and probably is now even below $500 at this point, right? And this same idea is directly correlated to how buyers and sellers operate in the marketplace. So, for example, right, generally the amount of shares in distribution is constant, right? That's our supply. We'll say in a perfect situation, the number of shares isn't really increasing or decreasing on the open market. It's just staying fixed. Now, that's not actually true, and we'll talk about that in a second. But demand can change, right? Demand can change for so many different reasons. Like, for example, if there's a promising earnings report or news release that's upcoming, or a big conference, or a new collaboration, or an acquisition, or maybe a really bad earnings report, right? That can all impact demand. So stocks move based on that imbalance between supply and demand. And I deferred the conversation on the change in supply, but companies can also impact the supply of their own stock, right? They can issue more shares where we typically see the price of the stock decrease, right? Because the supply has increased and demand stays the same, so the price needs to drop. And companies can also do share buybacks where the supply decreases and demand stays the same, so the price goes up, right? Pretty simple. The next rule, which we covered a little bit more in detail just now, was cause and effect. And again, as we talked about, volume is the cause, price is the effect. Finally, we have the same concept, just said a little bit differently, which is effort versus result, which again was kind of ties back to that same concept that or example that we ran through earlier. In general, and this was a rule from, I don't know, Albert Einstein or whoever the physicist was that had Newton, I think, his third law, who said every action must have an equal and opposite reaction. And while the market doesn't behave like physics and gravity and that sort of thing, in general, when we see high volume, it's very typical to see a large move in price. And in general, when we see low volume, it's very typical to see minimal moves in price, right? And we can see this exhibited very clearly, especially recently. I assume a lot of us traded through this recent pullback due to tariffs or bear market, technically. And we could see, right, high volume at the very bottom, I mean, incredibly high volume, preceded a massive move higher in price. And if we zoom out and take a look on truly how high this volume was, which was an example I think we did last time, this was the highest volume since March of 2020, right? And if you remember what was going on in March of 2020, hopefully you didn't forget already, but that was during COVID, right? Which was basically the most uncertainty we've faced as a global economy in probably the last 10 years, maybe even since the global financial crisis in 2008, the most real uncertainty, right? It was something that basically nobody has really lived through in the modern day, a global pandemic. And this was the level of volume that we got during that period. And back just a few weeks ago, we had some global tariffs, right? There was a lot of uncertainty for sure. And we got volume on the same level, or I guess in the same realm of just extreme. And the last point that I'll make before we move on to the new content is that volume very directly is correlated to a financial value. And what that means, and what I mean by that is, for example, on these days, the S&P was trading around 200 million volume. And we'll just say the average price was about 5 million, right? If we're trading, or excuse me, 500. So if we're trading 200 million volume with an average price of around $500, that's over 20, let me make sure that, yeah, that's over $20 billion that exchanged hands in a 7-ish hour period. And that's on a single stock, right? $20 billion exchanging hands in not even a full day, right? That is what volume actually represents, right? It represents big money making significantly large transactions, repositioning themselves, panicking, getting into the market in waves, right? It could represent a whole lot of different things, but fundamentally it means huge amounts of money are moving around. And we'll talk about why that's so important in just a couple of slides. So with that, let's get into the new content for today. Let me pull this up so I could see this here. Okay, so we mentioned even today the importance of paying attention to volume when we're nearing key levels, right? As price nears key levels, sometimes we call it like testing that level, right? It's going to test resistance or test support. Also, we could hear this concept described as testing the market. These concepts are nothing new, right? Just like we talked about in our introductory lecture, nothing in the market is really new ever. And as we know, in general, high volume would correspond to a strong breakout, and low volume would correspond to a weak breakout. And in general, also, 80% of breakouts fail, which I know a lot of you guys have probably heard Dirty River mention that same quote from Al Brooks, legendary day trader, both River and Al Brooks. So 80% of breakouts fail, right? And what we need to see when we have a breakout that is more likely to succeed is this high volume, right? Because that's what corresponds to a truly strong breakout. So let's take a look at some examples. Again, this is this concept of testing the market. So here we can see a nice strong trend higher into some significant level of resistance, right? And we can see as price moves higher, we have these nice increasing size volume bars as price moves higher. Then all of a sudden we get this very high volume test, right? And we see this bar moves below the prior candle on increasingly high volume. Then in another example, we have the exact same high volume as price moves higher, except this test corresponds to low volume, right? Which one of these examples do you think is more likely to break out? And I'll leave you guys, you could either answer over voice or over the chat. Which example, the one on the left or the one on the right, is more likely to continue to push higher? Which one do you guys think?
The first one.
Okay. Why?
I'm gonna tell you. Okay, I would say because the bar is more filled on it. I could say. Actually, hold on. I changed my mind. It's gonna be the second one.
Okay. Why? And why did you change your mind?
Because there's no wick on top of it.
No wick on top of it? Why'd you change your mind?
Because I've seen that. I've seen it before.
Okay. Anybody else? Any thoughts?
I might be wrong, but I'm learning.
That's okay. You might be wrong. Yeah. You might be right. I won't say yet. I want to see if we can get a couple more answers. What do we think, guys? Which example do we think is more likely to continue to move higher? The example on the left or the example on the right? Again, the example on the left, we're seeing that high volume selling as we push into resistance. This example on the right, we see low volume selling as we push into resistance. What do we think? There's got to be somebody other than our friend Denise who has some ideas. Arden thinks left. Okay, a couple examples of left. All right.
On the volume,
You said what, Scotty?
it's just selling volume that you're showing there, and it's not buying volume, or is that overall volume?
So this is going to be, well, that's actually an excellent question. In general, right, volume bars are always going to show overall volume. And what we'll typically say is if the bar is red or bearish or whatever you want to call it, we'll attribute that volume to selling volume, right? Because the overall bar closed red. So we'll say sellers dominated in this period, and we'll say this is selling volume. In reality, there's more that you could do to kind of break it up a little bit because obviously there's an imbalance between buyers and sellers in this period. But for now, let's just say this is selling volume, Scotty.
Then I would say the right.
Okay, cool. I like how we have a couple different answers, guys. Let's talk through it. So let's focus on the left example first, right? Let's look at this in detail. And let me take a screenshot of this so I can kind of talk through it all together. I really appreciate the participation. This is great. Okay, so let's just start with this bar, right? This is going to be kind of our average volume here. And if we just draw a line and say this is kind of our average, we can see we have a couple volume bars with above average volume. Here, 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 and here. And you'll notice every single above average volume bar corresponds to a bull bar that breaks a previous high, right? Here, we have this bull bar on above average volume and it breaks a prior high. Here, same thing, and here, same thing, right? And that got really messy really quick. I don't know how to erase this all, so I'm just gonna leave it. And this final red bar right here is where we see even higher above average selling volume, right? This is the highest volume we've seen in this entire trend, and it's dominated by sellers, right? So what does that tell us, right? Well, prior selling bars, which we only have one of, but there was very few sellers, right? Volume was incredibly below average. Now, all of a sudden, we have a large amount of sellers. And let's look at this example, right? We have basically the same volume patterns as price moves higher, right? Generally speaking, above average volume as price moves higher on the bull bars. The only difference is this volume here and this lower wick, right? What is this telling us? Well, first of all, the amount of sellers between these two examples is significantly different, right? On the left, we have far above average sellers. On the right, we have below average amounts of sellers, right? And if we think of the market like a game of tug of war, and on one example, we have way more people on one team, and in the other example, we have way less people on that team, well, who do you think is going to win the game of tug of war, right? If one game, the team has 20 people, and if the other game, the team has 5 people, well, you're probably going to lose when you only have 5 people on the team as opposed to 20, right? Or at least you're going to have a lower chance of winning. So long story short, this example on the right is going to more than likely lead to a stronger breakout or an actual breakout, right? Because we're not seeing those large amounts of sellers in the example on the right like we are on the left, right? Once we start testing this horizontal level of resistance, again, the right example, we don't have many people present who are ready to sell. On the left, we have a large amount of people who have been waiting to sell, right? People who had a limit order at this level ready to take their position off. Does that make sense?
Yes, sir. So that wick makes a difference.
100%. The wick,
top wick. Okay.
the top wick, I don't know if it makes as much of a difference as the lower wick. Then honestly, I think the lower wick is the more important thing to pay attention to in this example.
All right.
The top wick is more negligible. This is an excellent question for Michael, and I'm going to address this real quick if we don't have any more questions on the example. Does that make sense, though, why everybody or why right is going to be the stronger trend overall? And the SPY probably had something like this going on intraday, too, at least a little bit. So here on the SPY, we have price pushing up to a massively important daily level here. Let me just remove all the studies real quick. So 596, right? 596. This is going to be, oops, now we're on the weekly somehow. 596 is our prior high, right? This was the previous high that we set in this uptrend, 596. Always going to be an important point in the trend. Look at today's price action as we approach that level. This should be a very important level of resistance. But the first time we get sellers, right, if we just draw maybe an approximate volume average somewhere around here, it's really not that significant. You know, is it a little bit above average? Sure, right? But is it blowing us out of the water like something like this? No, right? So we have kind of above average selling. We get a small pullback. We test it again. We fail this breakout, right? So here's 2 failed breakouts now. We get a retest again on, oops, I'm doing this on the wrong drawing set, but that's fine. We get a retest again on declining selling volume as price moves lower. And then we break over that level again on above average selling volume, which again is on par generally with the selling volume, and continue to move higher. And I'm going to manually clear this up because I want to zoom out just a little bit and talk about this even in another way. 1 second. So let's draw this 595.54 level again. 1 second. 595.54. This is a good example to talk through, especially since it's so recent in everybody's mind. And let's zoom out to look at the 5-minute over the last 20 days. Let's see if we've tested this level during market hours recently. Should have back here. Okay, not as good of an example as I thought it was going to be. There's not very many sellers here at this level either. We just didn't make it back above. It's good to see this though, right? In general, we didn't break out this time around, but we didn't see that significant selling at that level really ever, right? Which is a good thing. It's good to see that in an uptrend. So I was hoping to see a little bit more sellers the first time it came to the level, but we didn't. I guess that's fine. Okay, that's our first example. I want to kind of switch gears a little bit and talk about a similar concept that's adjacent to this idea. This is an interesting one. I made these slides when AI was kind of first coming out, so that these next images that I can see coming are pretty unique. So this is a little bit of a prompt, and think what it takes to fill and empty a massive warehouse, right? Think about what Amazon does when they spin up a new warehouse, right? Do you think Amazon takes a container ship out of the ocean and flies a container ship directly to their new warehouse in Kansas City and unload every single container all at the same time? Or do you think that the container ship maybe lands at the port in LA or in Missouri or Mississippi or whatever? Some smaller boats sail up the river. They have some trucks that unload the containers. They have people in there who are packing the shelves and forklifts that are putting things on shelves, and it takes a lot of time? Or is it more of an immediate process where you just buy all the stuff and automatically it's in the warehouse and you're good to go and you're ready to start? I think the analogy got a little bit away from me because I started confusing myself a little bit with that one. Long story short, filling a warehouse isn't an easy or simple process, right? It takes a lot of time when you're filling a new warehouse. Think about purchasing all the merchandise and putting it on all the shelves and loading it all up and getting the employees ready to staff the warehouse. You can't just click a button, buy everything, and boom, I got everything I need. It's all ready to go, right? It's not so simple. So these are my AI generated pictures of a warehouse. So in the stock market, a similar sort of workflow happens, right? And these are two phases commonly referred to as accumulation and distribution. Starting with accumulation, this generally occurs when smart money deems a stock is at a low, in quotation mark, price, which again is the accumulation phase. And it's called a phase for a reason, right? In general, and this is for months and year-long bottoms, so not necessarily what we saw recently, but in general, when a stock is forming a long-term bottom, it takes months and years of accumulation by large funds to pick up the positions that they're looking for. And we'll review a lot of examples of this. One that I want to point out just now that we'll talk about is, again, Hood, one of my favorite examples in recent history. If we take a look at this, right, Hood is obviously up massively over the last 3 years. This down here, which I already have it boxed, is a textbook example of an accumulation phase, right? The stock literally did nothing for 3 years. 2.5, basically 3. It literally did nothing. It went absolutely nowhere. It went between 8 and 12, which that's a 50% change. But in the grand scheme of things, especially when the name was trading at 85, it's nothing, right? It's not doing really anything. It's just sitting in a range, right? It's not making any progress in either direction. It's not in the trend. This is a textbook accumulation phase. And the reason this sort of phase or phenomena occurs is because funds are a lot less flexible than traders like you and I. They can't just go all in on a position. They can't just YOLO their portfolio on a stock like one of us could, right? And not to say that's a good thing, but anybody in here could go buy a full port of SPY calls tomorrow and nobody's going to blink an eye. And they might lose it all. They might double their money. Nobody really cares. If a fund does something like that, they could have the SEC knocking at their door the same day, just because of the fact that they're subject to so many different regulations, and they could impact the market. And they have different requirements set by the funds that invest in them and their stockholders and their board members. All of those sort of factors come together to make general asset holding companies and large firms a lot less flexible, right? They can't just get into a position in a single day, right? Which is great for people like us because we can see this sort of accumulation happen over long periods of time, right? And the way that that's made clear to us is by these large, significantly above average spikes of volume as price does absolutely nothing, right? Look at these significantly above average spikes of volume. I mean, I can spot them from a mile away, and I'm sure the rest of you can too. All of these above average spikes in volume while price is basically doing nothing, right? So as we all remember from our prior examples, typically when we see big volume, it's common to look for a big move in price. We're not really getting that in this example, right? Price really isn't going anywhere, but we're seeing those big moves in volume. Well, this is the accumulation phase. So let's talk about an example. So in the book, they call it a campaign, which I kind of like that idea. And we can see it starts looking the exact same as the example that we just looked at, right? Price sits in a longer term range. We see very far above average volume throughout the accumulation phase. And basically, once the name breaks out, it's very typical that whatever firms have already purchased the stocks that they're looking for. And the book gets into this concept a little further. I won't get too far into it, but basically, the book argues that funds get so involved into the stock to the point where they start manipulating the news and they start, finding ways to get the company to release positive PR and basically force this breakout to happen because of changes in the company or in the news media or how things are covered. That maybe is true, maybe it isn't. I really don't care, and I don't really care to get into that, but something to consider. The opposite of the accumulation phase is referred to as distribution, which is where stocks are distributed or sold by smart money at high prices, which is the distribution phase. And you'll hear me continue to throw this term of smart money around. This is absolutely a real thing, right? There's funds and firms who truly are incredible investors, who truly know the next big names years or months before anybody else has any clue, including us, right? And that's just always going to be the reality, right? They have access to information that we don't have, knowledge that maybe we don't have, or just, maybe they're talking to the people that we'll never have access to. Maybe they have insider information. So they're able to get in at really good prices and they're able to sell at really good prices. Again, on the flip side, the positive for us is that we can see all this, right? All of this information is visible to us, but it's up to us to recognize these patterns in the charts and see when volume is far above average and we're sitting in some kind of range where it starts to look a little bit more like distribution or it starts to look a little bit more like accumulation. And again, just to take it another step back here, these are concepts that are more typically applied on the longer term, right? So it's not something that I would expect to see you start applying, on the 1 minute intraday on the SPY, right? That's not necessarily something that I would encourage, but maybe it's possible, who knows? So let's look at the example of the distribution phase. Again, they use the same term, campaign. We have a consolidation after a long uptrend up, and we have this high volume throughout this entire consolidation, which again, right, thinking back to our previous example where when we were testing the market, seeing large amounts of heavy sellers at resistance is never a good sign, right? Large amounts of sellers at resistance means people are willing and able to sell, right? They want to get out of a name. And especially when we see this high volume right off of a key level, it means people had orders waiting to get out at that spot for whatever reason, right? Again, we talked about this in the first lecture. We don't ever really know exactly the real reason why people are buying or selling, but we don't need to, right? We don't need to know why this fund is rebalancing their portfolio and buying this. It really doesn't matter. All that matters is it's actually happening, right? Because as smaller investors, we don't really create trends. And, you could always make an argument that maybe that happened or GameStop or something. I don't really care to get into that. But in general, right, smart money is who really is actually moving the market. We have very little impact, and hopefully nobody takes that in a negative way. It's a truth, right? And it's not a bad thing. So do these concepts of accumulation and distribution make sense?
Yes, sir.
All right.
And Tosi, I think that thing that we did before, like picking left and right, is a good thing, so people can learn. I think we should do that more.
Okay, I appreciate that feedback.
Yeah.
Thank you, Dennis. I'll definitely do that more. Yeah, I like that. I'll see if I can get some more examples like that for us in future lectures. Let me write that down because I'll forget, I promise.
So using the term and definition of campaign that you have here, wouldn't a quote unquote GameStop viral stock jump be considered a campaign?
You could say that. Yeah, I would say you could say that. And if we take a look, we'll know for sure based on the chart. So let's just take a look at this. Yeah, I mean, just based on this volume alone, you can kind of see it, right? You can see this random above average volume throughout a period where the stock really was doing nothing, right? And even before the move started, right? Let's just zoom in a little bit better so we can see what's actually going on here. This is probably a better example here. This is the most interesting part to me. We have a period where we have basically no volume, right? There's no real significant above average volume days. And then all of a sudden, these are the things that really fascinate me. We get 308 million volume basically in back-to-back days. And if we zoom out before this day, right here where we got the 308 million volume, that had never happened before that. And let's even zoom out further. these are the things that I really love to look for when doing volume price analysis. Let's just look at this a little bit more in detail. So Scotty, right here is what I was talking about. These two volume bars that hopefully you can see, GameStop had about 30 million or 300 million volume in back-to-back days. Looking left, that never happened before. Literally, it never had volume that high. It had 165 million volume, and that's really it. So this was record volume, double the previous record. Those are the things that I really love to try and spot because, I mean, again, you could have never predicted what GameStop was ever going to do, and I'm not going to be the one to argue that because I think that's a little bit ridiculous. I mean, if you were buying here and saying GameStop's going to do however many thousands of percent, I think you're smoking the same thing that I want. But anyway, long story short, these are things that I like to look for. And in terms of like a longer campaign, I think you could make the argument that that was occurring. I will say though, for a name like GameStop, you could also definitely make the argument that like it wasn't really big funds that were buying this. It was more the big funds were selling it and kind of the retail traders that banded together to start buying it. And I don't know how much truth there is to that statement because I didn't follow it that carefully. But does that answer your question, Scotty?
Yes, it does.
It's a great question. Thank you. Okay. So I've had a full lecture on stage analysis before, so I definitely won't be able to do it justice in the time that we have left. But stage analysis is kind of an extension of the concept that we just talked about with accumulation and distribution. And I don't remember what trader came up with this, but basically the argument is that stocks move in kind of 4 stages, right? Where stage 1 is our accumulation phase, stage 3 is our distribution phase, and stage 2 and stage 4 are the trends between them. And the way that this is typically represented is by referencing the 40-week moving average. And this is just one example of how you can start to combine the concepts of volume price analysis with other ideas or schools of thought. So for example, if we go back to our Hood example, which I'm going to stick with Hood instead of GameStop, even though GameStop is a fun one. I think it was a little too, I'll say, driven by hype. Let's pull up a 40 simple moving average and let's get on the weekly. Let's make this clear for us here. So basically the argument is that as we're sitting in this accumulation phase, the 40-week moving average is generally flat. And once the accumulation phase begins to end, we start to see that upward slope in the 40-week moving average. And as long as we're trading above that 40-week moving average, we're basically in this stage 2, or I don't even know what to call it, basically uptrend stage. And we can kind of see how that played out in Robinhood, right? So we've identified that this is absolutely some period of accumulation, right? We have multiple significant above average volume weeks throughout this entire period. And then once we break out of this prior high, this is a pretty interesting one, right? Hood set a high right around this 1250. We break out of this high again on record volume, right? Notice how this entire move started. I actually want to focus on this because I think this is a good segue into our examples. Notice this entire move actually began once we got a breakout on above average volume. Look at this, right? This week right here, we got a breakout of the prior highs on above average volume. That's it, right? So we could have sat around and, maybe we could have accumulated a position in Hood too, or we could have been a little bit patient and started to get involved once we see this breakout of this longer term base. And this was a big deal, right? I mean, if we draw a horizontal level just across from the previous high, we could see how much progress it made in a single week. It cleared this high, this high, this high, and this high. And the most important thing that I like to pay attention to is the amount of volume on each of the previous rejections. So on this rejection, you can see we had above average selling volume. On this rejection here, long upside wick, above average volume. And those are basically the 2 main rejections. On here, we had decreased selling volume. So we can see the amount of sellers willing to sell in this area has started to drop right at this time frame. And then, I did this on the wrong drawing set again. I'll have to clean this up later. And then finally, we get the breakout on significantly above average volume, an amount of volume that we hadn't seen in, again, basically 2 years. And these sort of kind of historical volume comparisons are some of my favorite things to do. And it's so simple, but so powerful at the same time, because all you're doing is looking left on a chart and seeing how significant the amount of volume that we're actually experiencing truly is. And when we're getting volume that's basically a 2-year record, it's a big deal, right? That means more funds want to trade this name than at all during the last 2 years, right? For some reason in this week, and I don't even know why people bought. Is it earnings? Yeah, earnings, right? I don't even care if the earnings report was good, bad, if guidance was good, bad, doesn't matter. None of that matters, right? For today. I'll be careful. Obviously that does matter, but let's just act like it doesn't matter. The most important thing here is that we're seeing historic volume on a breakout. And again, obviously I have the benefit of hindsight where I can see that Hood's now, 500% higher than it was at this point, but you could do that on anything and say, oh, look at all these names that increased so significantly. But these patterns repeat, right? This isn't the first time this has happened. There's so many names that did this over the last few years, and there's so many times that this is going to happen again. I forget why I started talking about, stage analysis. So anyway, stage analysis basically says that once we start to see this 40 simple moving average begin to increase in slope and prices starting to hold above it, typically that's when that stage 1 phase is getting ready to end and we're getting ready to transition into that uptrend to stage 2, which interestingly enough is right around here we started to see the slope of that 40 simple moving average creep up, right? This was really the first time that we got a nice kind of steady uptrend in that 40 simple. Some little bit of a blip in it here, but this was that first time that we really started to hold it as support. We set a higher low as well, which was big, and then ultimately had that breakout. And obviously everybody knows what's happened with Hood since that time. So that's kind of our first example to get us warmed up and ready to look at some more real world examples. We have one question in the chat that I'll take a look at. So looking at the SPY 15-minute time frame, there was a large green volume candle before closing. What does that indicate? That's a great question. So volume follows patterns, just like anything. And in general, volume at the close and at the open is always above average. That's just typical, right? So there's not necessarily anything to infer from the volume candles directly at the close or open, because you could see on this day, right, we had a really above average selling volume bar, but price, moved maybe 50 cents lower and then close higher, right? So volume is always higher at the open and close. There's kind of one main reason for that, which is liquidity is typically higher at those times, because you can set orders, like big firms typically set orders to buy or sell their blocks of shares in the open market at the close and open, because that's just when people are typically making the most trades, right? Because when you're trading near the close, you're trading basically that daily candle close. And trading near the open, you're trading based on everything that happened in the previous night, sometimes the previous weekend, since close the last day. So a lot could change in that 16, 17-hour period. So anyway, long story short, nothing too significant from this specific bar alone. I would be paying more attention to how price overall closed on the daily, which it closed basically right at resistance for all intents and purposes. 596 is basically resistance. So any move above here, you got to start looking higher. And it's probably a little bit more clear on SPX. Oops. Yeah, about the same. Except you have the same pivot right around the same area as well. 59.70-ish. It's really the spot to beat. Cool. Good question. All right, we got a couple more minutes and a couple examples to get through. So let's talk about a few real world examples. This one is Dell. This is from a little while ago. And here we can see a pretty key horizontal resistance level. And the price action on this name isn't perfect. We can see it's a little bit funky. But here we have 150 as that horizontal price level. And notice the first time we come into this level, we get a real big rejection, right? Bear bar closing near its low and pretty decent selling volume as well. The second time, again, real decent rejection. Third time, another rejection with a failed breakout. Fourth time, fifth time, and every single time, notice how on average, that volume really started to taper off, right? What does this mean? Well, all it's representing is that the amount of people who are willing and able to sell at 150 is decreasing, right? Again, we can think back to maybe some real world analogy where on the first day that the PlayStation released, maybe there's 100 people in line to buy it. Then on the second day, there's 50. Then on the third day, there's 60. Then the fourth day, there's 20. And then 2 weeks out, nobody's in line to buy it anymore. That's all we're seeing here. right? The demand of people wanting to sell is decreasing. We could see the first time we hit 150, we had a large group of smart money individuals or big money traders unload their positions because they wanted to sell at 150 for whatever reason. And again, we got future tests of that level, continue to see that selling pressure. But ultimately, nobody was left, right? This is one of the more fascinating examples to me. Just 4 trading days passed, and we have basically, 15% of the sellers left at this level that we originally had. These are the sort of things that you want to start to key into, right? They make it pretty obvious when the selling's beginning to slow down because they can't hide it, right? It's not something that is able to be obfuscated. Volume represents the amount of shares bought and sold. And once we see that volume begin to drop off, we know people are buying and selling less. So this is a really good example of that concept. And obviously, again, kind of as I discussed, once we spent a little bit more time testing this level, the amount of selling significantly decreased. The last interesting point to mention here is the retest of this level, right? Notice how once we retested this level, we had pretty weak selling volume, and that first buying bar, again, is above average, right? So the first opportunity that buyers take to get back into this name, they do it significantly. And obviously this name continued higher after this move. And also another big important piece of this was that volume increased on the way up, right? Which again is that example that we talked about last week where we see volume confirming price, right? This specific setup couldn't get too much better for us, right? And all we had to do is, even if we didn't realize this happened, and, obviously it's pretty easy to miss this gap up because there's not any real reason for us to be long under 150, right? Makes sense. But once we see this gap up, we can start paying attention, right? We know 150 is a big level. We know it's important. And we know very clearly that the amount of sellers heavily decreased at that spot as we continue to test it. So we should expect that once we come back to that level, it should remain pretty important. And this time, now that we're above it, this is a place of interest for buyers. And obviously, this level held. Okay, another one. This one pretty nicely represents that accumulation concept. We could see that same idea just on a real chart where if you look to the right of the chart, you can see kind of the average volume normally for Shopify. And if you look to this period between 2022 and mid-23, overall volume was way above average. Like you can just see very clearly this group of volume bars compared to this group of volume bars are not the same. Like the height of these on average is much more prominent than the height of the volume bars towards the more recent price history. And we're getting less movement in price, right? Price is sitting in a range. This is going to be a textbook accumulation, right? This is exactly something that we would want to see if we were looking for shares to begin getting accumulated. And then again, right, we have that same sort of concept with that 40 simple moving average. That uptrend doesn't really start until we start to see that slope upwards in the 40 simple. This one didn't necessarily have a big result. It went from somewhere like 50 to 90, so not a massive trade. But exhibited the concept pretty well. So it was good enough for me to highlight it. And obviously we got right above that 40, held it nicely, and continued higher. Any questions on those two examples?
I don't have a question about those examples, but a general kind of question.
Yeah.
So, as I've learned from OOT, the options market is a zero-sum game. There are people who are always buying and people who are always selling.
That's correct.
So, if you start to see over a period of time an imbalance in buyers and sellers, does that give a significant indication towards where the market might be going?
Yeah, that's an excellent question. I think the answer is always going to be yes. And the reason why is because the imbalance between buyers and sellers is really the imbalance between supply and demand. Like you mentioned, the market's a zero-sum game. So not only options are zero sum, but equities and all other derivatives, right? For any buyer, there's a seller. So when we talk about buying volume, right, this 200 million or however much buying volume is also technically 200 million selling volume. The difference, though, is that price increased during this period. And there's some calculations that can be done to kind of mathematically determine the difference between supply and demand. We won't get into it today, but the important thing is price increased during this period, which means demand was greater than supply. So price had to increase to basically match that new level of demand. And that is basically an indication, obviously, just like anything, it's not a guarantee, but it's definitely a ball in the court of either a bull or a bear, depending on the setup. So again, just going back, I actually have a full PDF of different examples. So let's pull that up really quick. Let's see if I have some good ones. So just to kind of drive this point home even further, these are some of the biggest trades that occurred in 2024. And every single one of these had significant levels of buying volume before and during the breakout. Kava, you could see record volume as it broke back above the EMAs. Carvana, again, record volume as it did basically nothing. NVIDIA, above average volume as it broke out and obviously continued to move higher. GEV, this was one of the ones, not so much. So in general, PLTR, this one's pretty obvious. So in general, I'm always going to be in the camp of the fact that, well, I guess I shouldn't say fact, of the opinion that volume absolutely can indicate future moves in price. Now, just to be clear, Scotty, does that mean that you should only look at volume and close your eyes and say a prayer every time you take a trade? Obviously not, right? I mean, just because there's people buying doesn't mean they're not wrong, but it definitely is a really high quality tool and an absolutely essential part of any trading strategy, in my opinion. Does that answer your question?
How would, yes. How would you go ahead and come up with a point at where you think it would stop? Is there any kind of indicators where you would think that?
Well, what do you mean where it would stop? Are you talking about like a move in price?
Yeah, so let's say you're watching the volume.
Yep.
Let's use something simple like XLE, right?
Okay, sure.
Moves relatively slowly, so it's relatively easy to go ahead and pay attention to it.
Mm-hmm.
When you start looking at the volume for it, one of the things that I've noticed is generally the first half hour of a day, there's large moves.
Mm-hmm.
And I've noticed that sometime after lunch, you get a little bit more action. And then at the end of the day, it kind of tapers off usually.
Okay.
And that all corresponds to the volume that I've watched. And I'm just wondering, how far do you see, if you're going to use that to base some of your trading decisions on, and obviously there are other things to come in, like, moving averages and stuff like that.
Sure.
On the short term, does the volume discrepancy provide a reasonable, good indication, or is it me overthinking it and seeing patterns where they don't exist?
What do you mean the volume discrepancy? Like, are you saying like the change in kind of the
Well, let's
magnitude
take
of movements between
24-hour period. If you look at the total volume on a 24-hour period, it's either going to be positive or negative. The likelihood of it staying exactly the same is very, very unlikely.
You mean compared to the previous 24-hour period?
Yes.
Okay, correct. I agree. Yeah, it's basically impossible.
So what I've tended to notice is when that number is positive, I tend to see that
I think I lost you there, Scotty. I can't hear you right now. I don't know if that's just me though.
that X Elite goes up. Currently is that I don't get that might go ahead and help me decide.
I just I don't know if that was just me, Scotty. I apologize. I couldn't hear you for the last like 30 seconds.
Yeah, most important.
Yeah, it's most probably my internet. It's been bad since they upgraded me.
Sorry, do you mind repeating yourself?
So my biggest problem with trading right now is I don't get out quick enough, or I get out too quick.
Okay.
So I can make 5% on XLE all day long.
Mhm.
It's when I try to push it a little bit further that I get into trouble. I tend to either drop out too soon at 5%, or I hold it too long and then all of my gains go out the window.
Right.
So what I'm trying to do is find some sort of set of indicators that would, and maybe it's based on volume, maybe it's based on volume and price, maybe it's a combination. Most probably, it's a combination of both of them. That gives me a reasonable that I can set a reasonable expectation that it's still going to go up or it's going to go out.
Yeah, I think I'm following now. I want to ask one more question. What is your trading style? Are you scalping? Are you day trading? It sounds like to me you're doing one or the other. Which is it?
So it's more scalping.
Okay.
But I don't have a problem with day trading, and I don't really have a problem with swings, though I don't do well on swings generally.
Okay. I'm following now. So the first thing that I want to commend is that when you were talking about indicators, you mentioned price and volume, which I want to encourage that mindset. You're never going to find, I'll tell you now, you're never going to find any indicator that isn't price or volume that is going to tell you more than price and volume. Those are always going to be the most important, fundamentally, right? And on top of that, you're also never going to find an indicator that tells you when price is going to change directions or continue. It just doesn't exist, right? That would make trading biblically easy for the rest of us, and I think probably render markets useless. Long story short, it all comes down to pattern recognition in price and volume. And to me, at least as a scalper, well, sorry, not as a scalper, but with a scalping mindset, you got to be paying attention to key levels as well. So like, for example, I would obviously start with the weekly, and it sounds like you're pretty familiar with XLE. This 8303 spot seems to be massively important. We could maybe mark a few more, but for now, we'll just focus on this area since we're trading right around here now. And let's just take a peek at this. We can see how we've been behaving at this level on the daily, right? So again, this is all just preparing for a trade. It's studying where the name is at. Here we can see in general, we've had sellers present at this 8303 spot, but nothing too crazy, right? Nothing significantly above average, which is good, right? It doesn't necessarily mean anything in the moment. And we also have a decent gap to fill to the upside. So all I'm doing right now is I'm setting a frame of reference. I'm setting expectations for what price can actually do. And to me, price can't do too much until we get above 83, right? 83 is basically a brick wall. And if we get down to 80, 70-ish, that's a pretty key level of support, right? 2 holds of this area. It's pretty key, right? Good spot for us to watch out for. Now let's go into the 5-minute, right? Let's take a look at what happened at 83 today. So let's say, for example, I take longs, above pre-market high, right? I don't know exactly how you're trading. If you're scalping, you probably didn't do that, I would think. I'm not sure. Doesn't matter. Anyway, let's say I take longs above here, right? First, it's all about how I define my trade, right? So if I'm taking longs above pre-market high, you would be an idiot to not try and sell some at 83, right? It was a clearly important level the previous day. It's a big level on the daily. If you're not selling a little as a scalper at 83, you're doing something wrong, right? So that's the first thing, setting realistic expectations for your trade. And the way I do that starts with key levels from the daily, and then obviously is then changed by however things behave intraday. Trying to think about where I was going. So on a trade like this, and obviously I have the benefit of hindsight in my hands, I'm trimming some at 83 and letting the rest ride for a little while. And I don't personally scalp at all, so I can only give so much advice on that. But generally as a trader, right, if you can trim a little bit off at some point in the position and then just start waiting for the wheels to fall off the trend or some kind of reversal signal, there's no reason not to stay in a position. So like, for example, this rejection off of this gap, this may have taken me out full off the position, right? I don't like that bar really. Elevated volume, rejecting that gap entirely, I could see myself selling. But also as a scalper, you got to be ready to get back in once your trade is still valid. So once you see us, maybe break above that prior high and hold it, try and scalp some longs off that spot, right? So I feel like I'm not directly answering your question, and I don't want to dance around it. What do you need me to clarify?
No, this is all information that's useful to me.
Okay, good. Yeah, sometimes I need to focus better. But Scotty, it sounds like you're on the right path, and you're focusing on an individual name, which is excellent, and it's something that a lot of people can't do, which is great. You're doing the right thing. And honestly, scalping is hard, in my opinion. I can't think that fast. Like, I just don't like having to make decisions that rapidly. And as a scalper, you need to do that. So the planning is obviously really important, right? You got to come into the day ready to execute trades and know where you're going to do it and think through them. And obviously having the daily levels, I think that was a big part of a trade like this, right? Is understanding where the name is at on the daily and where it starts to become a little safer. And to address directly your point of staying in too long or getting out too early, to an extent, that's always going to happen, right? You're never going to be perfect. There's always going to be times when you sell too early. It's just reality. It's literally reality. And even somebody like Tilio, who's been trading probably 15 years at this point, continues to sell early. And it's a reality, right? And there's ways you can mitigate that. Like, for example, if you buy 5 contracts and you sell 3 here and 1 here and leave the 1 to run, that can be very helpful and very beneficial. That last runner, as people call it, can really do wonders for you. So that's one way to kind of mitigate the impacts. And in terms of selling too late, really, at least as a scalper, you got to be a little bit more aggressive. So once you see kind of in a scalper, scalping mindset, I'm trying to put myself in your shoes here. Contracts are going to erode pretty quick. So you got to remember that you're not in there for a long time, no matter what. I mean, really, your trade shouldn't last too much longer than an hour or two anyway. So continuing to lead with that urgency is probably the best advice I can give you. But honestly, I don't scalp really ever. So I can't give you that targeted advice on that piece. But
yeah, I think I also have the problem of that I've not actually, while I've been in OOT for a while, I haven't been actively trading the whole time. Okay. And I have a bit of a confidence level on when to go in and when to get out.
Like you're nervous a little bit.
Yeah. Like my eyes are peeled on the chart,
And that's okay, right?
Blinking becomes optional at that point in time.
And that can be hard as a scalper, and that's why I don't personally do it. And I'm not here to tell you how you should and shouldn't trade, but I can't do that. And as a scalper, you do kind of need to be locked in. And honestly, I would recommend reaching out to River to see how he kind of deals with that, because it's not something that I've really felt before. Well, it is, and that's why I stopped trying to take short-term trades like that, because I need to be in a more relaxed environment so I can think clearly. Because it is common, right? Scalping takes a lot of energy, and you really got to be thinking about what you're doing every minute. You can't just kind of sit back and wait like you can on a swing trade or even some day trades, right? It's especially when you're trading the same days. It can be stressful and very hard. It's not easy to be successful, Scotty. And I'm not here to discourage you. Again, I want to make that clear. But that's kind of the piece that I talked about at the beginning of the lecture is, you mentioned that you haven't been actively trading. Practicing is going to be the most important thing for you. The more you get reps in, the more you're looking at charts, the more you're taking trades, the better you're going to get. And if you want to be less nervous, trade with an amount of money that doesn't really scare you to lose. I'm not here to tell you how much money that is necessarily, but if you're trading 1 contract every trade and it's $50 contracts and you don't care if it goes to 0, great. You have nothing to be nervous about, right? And making sure that you're planning in advance also gives you less reasons to be nervous, right? Because you've thought through the trade already. You understand where the key levels are. You understand where your risk is at. So you don't need to be really scared, right? You just wait. So those are some things that you could try. Yeah, scalping's hard though, because it's not really something that you can walk away from. Like even as a day trader, I would suggest, setting some alerts and walking away, but you really can't do that as a scalper.
Yeah, make sure you have your levels too. Yeah, have some levels, and it's a combination of all those things. Yeah.
Yeah.
Okay, well, thank you guys. I didn't mean to hijack the end of the
Good
conversation.
No, these discussions are great, Scotty, because somebody has the same problem as you, and maybe they don't want to talk about it right now, but somebody's got your same problem. I mean, so you're helping other people by bringing this up. Everybody's been through the same thing at least once.
Can I
Yeah,
add
I
something?
think I've gotten knowledgeable enough to know how much I don't know, so that I can at least ask intelligent questions as opposed to, being a complete and total noob.
That's important. Did somebody else have something?
Yeah, I wanted to add on for the scalping. So, Scotty, I would say like paper trading, because that helped me a lot. Like finding levels to like where to like actually like sell and buy. And it helped me a lot with paper trading. And then when I move on to actual like real money, and then I get more clarity on that. But that works for me. I don't know if it works for you, but paper trading has helped me a lot.
I did a bunch of paper trading, and
Yeah,
it's just not the same to me.
I feel you. Yeah, I understand.
And in terms of percentage of successful trades, using some definitions I've heard, where a successful trade is that you got in, you got out, and you got more money. I'm at like 9 out of 10. The problem is the 10th one clobbers me.
That's always how it goes. The problem, and that is kind of the reality of scalping too, is your win rate's got to be pretty decently high. It's not really like, usually your losses can be difficult, but you got to work to minimize those as a scalper. At least when I talk to River, the majority of his losses are 10, maybe 20%. Nothing really more than that.
Yeah.
I keep and when I scalp too, I only scalp the downside. That's what has been working for me. You can scalp the upside, but downside for me is the most comfortable. Everyone has a different way of doing it.
And the longer time frame helps too. Yeah. Are you doing zero DTEs?
Yes. Like
if a stock,
if a stock goes a certain price, if it pushes up, and eventually there's going to be a pullback, and I wait for those, to be honest. And that's just my style.
And I'm kind of the opposite.
Yeah,
I'm kind of the opposite, because I have a, the calls, you can only lose so much, right?
Yeah.
Puts have a lot more risk associated with them. If you don't,
I mean, both
if you
of them
don't
have
have good
defined
stuff,
risk, right? Both of them have defined risk. I mean, it's the money you put in.
Yep.
I guess it just depends on the trend, right? In general, in an uptrend, you have a higher probability of taking a extra money home or a profit home on longs, right? Because the trend's in your favor. And in a downtrend, you have a higher probability taking money home on shorts. And that's kind of the balance, right? When you're going short in an uptrend, typically your win rate's a little bit less, but the amount of money that you stand to gain can be higher, where it's the opposite. Anyway, it's all a balance. That's the trader's equation.
Yeah, and Tostie, and I like when you mentioned like when you like to be in a trade and you like to be calm and collect. I like that when in calls. I like being in calls, going up, uptrend, sitting down. And for puts, I like scalping them. Well, it depends what market we're in. Right now, we're in a bullish market. You can say that, right? We're in a bullish market right now.
Oh, 100%. Yeah, you can now. I mean, I was in the camp where 2 months ago we were in a bear market full blown, but that's over. You got to be able to switch sides.
100%. I agree.
Well, guys, I want to definitely thank you for.
Of course, we lose Scotty. We lost you, Scotty. But thank you for bringing this up. Hopefully you can hear us. I can't tell.
And it'll be somewhat yelled at whatever trades I'm running.
We lost you for a little while, Scotty, but I think we heard what we needed to. We appreciate the question for sure. I mean, this was one of the best discussions we've had in the open mic lecture, I think maybe ever. So thank you, Scotty. Seriously.
Anytime.
Yeah,
I'll be
next time.
glad to pick your brains as often as I can get away with it.
Oh, you can get away with it. Anybody can get away with it anytime, not just you. Cool, everybody. Well, I think that is going to do it for tonight. This was a fun one on volume price analysis, lecture 3. And we will continue next week with some more advanced topics. So hope to see you guys all there, and we can definitely get into maybe another fun discussion like this at the end of the next one.
All right, Tostie, thank you so much, brother. Appreciate you.
Thanks again, and have a great night, and be well.
Thanks, guys. Yep, you do the same. Yep, appreciate your time, guys. Thank you so much.